Hey everyone, what's up? It's Pablo, and welcome back to the channel where we help you make smarter financial decisions. A lot of people think they need to be completely debt-free before investing. While that makes sense, it's not always that simple. That's why, in this video, we're diving into 10 essential tips for investing in the stock market. Even if you have debt, investing is the key to building long-term wealth. And the sooner you start, the better. Let's get started. Before you even think about buying a single stock or opening that Roth IRA, we need to talk about your debt. Start by creating a list of all your debts: student loans, credit cards, car loans, personal loans, the whole 9 yards. Write down the outstanding balance interest rate and minimum monthly payment for each. This might be a little painful to look at, but knowledge is power. Once you have your debt inventory, it's time to analyze. The goal here is to figure out which debts are costing you the most money because of high interest rates. Those are the ones we want to prioritize paying down first. Think of it this way. Would you rather earn a 7% return on your investments or save money by paying off a 19% interest rate credit card debt? It's like getting a guaranteed return on your money. Understanding your debt landscape is crucial for making informed investment decisions. Budgeting can feel about as exciting as watching paint dry, but trust me, it's the foundation of everything in personal finance. Whether you're trying to pay off debt, invest like a pro, or just have more control over your money, a budget is your secret weapon. Track your income and expenses. Once you have a handle on your cash flow, you can start making adjustments to free up more money to throw at your debt and start investing. This might mean cutting back on unnecessary expenses or finding ways to increase your income with a side hustle. The key here is to be realistic and create a budget that you can actually stick to long term. Start small, make gradual changes, and don't be afraid to adjust your budget as needed. An emergency fund is absolutely essential, especially when you're trying to juggle debt and investing. Think of it as your financial safety net. Life throws curveballs, and unexpected expenses like car repairs, medical bills, or job loss can derail your financial progress if you're not prepared. Without an emergency fund, you might be forced to go into more debt to cover these unexpected costs. But when you have that safety net in place, you can handle those emergencies without stressing about racking up more debt. The general rule of thumb is to have 3 to 6 months worth of living expenses saved in an easily accessible account. If that seems daunting, start by aiming for a smaller emergency fund of $1,000. Once you hit that, you can gradually increase it over time. Now that you have your budget in place and you're working on building your emergency fund, it's time to tackle those debts head on. Prioritize paying down your high interest debt first. Look at the interest rates on all of your debts and focus on paying down the ones with the highest rates first. High interest debt accrues interest much faster, costing you more money in the long run. There are a couple of popular strategies for tackling high interest debt: the debt snowball and the debt avalanche method. The debt snowball method involves paying off your smallest debt first, regardless of the interest rate. The debt avalanche method focuses on paying down the debt with the highest interest rate first. Ultimately, the best method for you depends on your personality and what you find most motivating. The key is to choose a strategy and stick with it. Now, let's talk about investing. I know it can seem intimidating, especially when you're also trying to pay off debt. But the truth is, you don't need a ton of money to get started. Starting small is often the best approach. One of the biggest myths about investing is that you need thousands of dollars to open an account or buy stocks. With fractional shares, You can invest in companies like Apple, Tesla, or Amazon with just a few bucks. This allows you to start building a diversified portfolio without breaking the bank. Another great option for beginners is to start with a robo-advisor. Robo-advisors create and manage a diversified portfolio for you based on your risk tolerance, investment goals, and time horizon. Even small, consistent investments can add up over time thanks to the power of compound interest. Diversification is a fundamental principle of investing, and it's especially important when you're trying to manage debt. Diversification means spreading your money across different asset classes, such as stocks, bonds, real estate, and commodities. The idea behind diversification is to reduce your overall risk. When you invest in a variety of assets, you're less likely to be wiped out if one particular investment performs poorly. It's like the old saying goes, don't put all your eggs in one basket. One way to diversify is to invest in a variety of individual stocks and bonds. Another option is to invest in mutual funds or exchange-traded funds, ETFs. Mutual funds and ETFs are baskets of stocks, bonds, or other assets that allow you to diversify your portfolio with a single investment. When deciding how to diversify, consider your risk tolerance, time horizon, and financial goals. If you're closer to retirement, you might want to shift towards a more conservative portfolio with a higher allocation to bonds. Dollar cost averaging, the investor's secret weapon. Dollar cost averaging is a simple but incredibly powerful strategy that involves investing a fixed amount of money at regular intervals, regardless of the market conditions. When the market is down, prices are lower, which means you're buying more shares for your money. Over time, this can significantly lower your average cost per share and potentially boost your returns. Think of it like buying your favorite coffee. When the price of coffee goes up, you buy less of it, but when the price drops, you stock up. Dollar cost averaging applies the same principle to investing. Another benefit of dollar cost averaging is that it takes the emotion out of investing. By investing consistently, you're less likely to make impulsive decisions based on short-term market fluctuations. Let's talk about the importance of staying informed about market trends. You don't need to become a Wall Street guru or spend hours every day reading financial news, but it's essential to have a basic understanding of what's happening in the markets and how it might impact your investments. Think of it this way. You wouldn't buy a house without doing your research first, right? Investing is no different. You need to do your due diligence and understand what you're investing in. Luckily, staying informed about market trends has never been easier. There are tons of resources available online, including financial websites, blogs, podcasts, and even social media accounts. Find a few sources that you trust and make it a habit to check in regularly. Remember, investing is a long-term game. Don't panic sell based on short-term market noise. Speaking of long-term goals, let's talk about the importance of having a long-term investment strategy. One of the biggest mistakes I see investors make is trying to get rich quick. They chase after the latest hot stocks or investment fads, often buying high and selling low. But here's the thing. Investing is not a get-rich-quick scheme. It's about building wealth gradually over time. The most successful investors are the ones who have a plan and stick to it, even when times get tough. When you're creating your long-term investment strategy, consider your risk tolerance, time horizon, and financial goals. Your risk tolerance refers to how much volatility you're comfortable with in your portfolio. Your time horizon is the length of time you plan to invest your money. Once you have a good understanding of these factors, you can start to develop a portfolio that aligns with your individual needs and goals. Let's wrap things up with one final tip. Don't be afraid to seek professional financial advice. A good financial advisor can actually save you money in the long run. They can help you create a personalized financial plan, choose the right investments, and avoid costly mistakes. They can also provide valuable guidance and support, especially during times of market volatility or uncertainty. Look for an advisor who is a fiduciary, which means they're legally obligated to act in your best interest. You can also ask for referrals from friends, family, or colleagues. Remember, investing is a lifelong journey. A financial advisor can be a valuable resource and partner on your path to financial success. So, there you have it, folks. 10 essential tips for investing in the stock market, even if you have debt. Remember, investing is a marathon, not a sprint. By taking a strategic approach, managing your debt effectively, and staying focused on your long-term goals, you can build a brighter financial future. Thanks for watching, everyone. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more personal finance and investing tips. Until next time.